Today, we are exploring a foundational topic that every novice investor needs to master before putting a single dollar into the market: exchange-traded funds, ETFs, and why beginners should stop trying to pick individual stocks. As you step into the world of investing, the media and social platforms are constantly buzzing with hype about the next breakout tech stock, meme asset, or high-flying corporate giant. For a beginner, the temptation to handpick a portfolio of individual stocks can feel exhilarating. It feels like real investing. Yet, diving headfirst into single stock picking without deep financial analysis or risk management is often a recipe for devastating losses. Whether you are building your first brokerage account, mapping out a long-term wealth plan, or seeking a stress-free way to grow your savings, understanding how ETFs work is the single most important step you can take. Let us start by breaking down what an ETF actually is and how it functions. An exchange-traded fund is essentially a pooled investment vehicle that holds a basket of multiple securities, such as hundreds or thousands of stocks, bonds, or commodities, all bundled together under a single ticker symbol. When you buy a share of an ETF, you aren't betting on the fate of one company. Instead, you are buying a tiny, fractional slice of an entire index or market sector. ETFs trade on public stock exchanges just like individual equities, meaning you can buy and sell them seamlessly throughout the trading day at market-determined prices. Moving hand in hand with this structure is the ultimate superpower of ETFs: instant, effortless diversification. When a beginner buys an individual stock, say, a popular electric vehicle manufacturer or a biotech startup, their entire financial outcome is inextricably tied to the operational success, regulatory hurdles, or executive decisions of that one single business. If that company stumbles, your portfolio takes a direct, unbuffered hit. By contrast, a broad market ETF tracking an index like the S&P 500 or a global equity index instantly spreads your capital across dozens of industries and hundreds of top-tier companies. If one company in the basket suffers a downturn, its losses are routinely offset by the growth of others in the same basket. Diversification is the only free lunch in investing, and ETFs deliver it instantly with a single transaction. Another major reason why beginners should pivot away from individual stocks is the illusion of control and the reality of stock-picking performance. Retail investors frequently believe that by researching a few companies online, they can consistently outsmart institutional analysts, quantitative algorithms, and professional fund managers who spend 80 hours a week analyzing market data. In reality, decades of market data show that the vast majority of individual investors underperform simple broad market indexes over long horizons. Stock picking requires not just picking a great company, but timing your entry, predicting future macroeconomic shocks, and knowing precisely when to sell, a combination of emotional discipline and foresight that trips up even seasoned professionals. We also cannot overlook the massive advantages of cost efficiency and simplicity that ETFs provide. Traditional mutual funds often carry high management expense ratios and upfront sales loads that quietly eat into your compounding returns. Broad market ETFs, on the other hand, feature rock-bottom expense ratios, minimal portfolio turnover, and high tax efficiency. They eliminate the paralysis of choice. Rather than spending hours trying to decide whether to buy Apple, Microsoft, or Amazon, you can simply own all of them, alongside hundreds of other leading global enterprises, in one clean, low-cost vehicle. Finally, we must recognize that adopting an ETF-centric strategy allows you to transition from speculative gambling to systematic, long-term wealth building. By focusing your energy on consistent, automated contributions into broad market core ETFs, you remove emotion from your financial life and let the compounding power of the global economy do the heavy lifting. As we wrap up today's breakdown, it is clear that ETFs offer the ultimate toolkit for novice investors: instant diversification, low costs, transparency, and freedom from the stress of single stock picking. If you found value in this deep dive and want to stay ahead of the curve on smart investing strategies, portfolio building, and wealth creation insights, make sure to hit that subscribe button and ring the notification bell. Drop a comment below letting us know what your first ETF purchase was or which index you plan to track, and give this video a thumbs up if you want to see more content like this. Thank you for watching, and we will see you in the next video.